Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, we are going to be talking about what's probably the third most boring but hopefully helpful topic of the last couple months, and that's bonds. So why the heck, we're going to answer the question, why the heck would anyone want to invest in bonds?
All right, so you said third most boring.
Third most boring, by my calculation.
By your ranking, what
Correct.
else fits there?
Yeah, I think utility stocks could be a little bit more boring.
Okay.
But maybe not, I don't know. Annuities, I think that was the most boring.
You think people who sell utility stocks are power brokers?
Oh, the power broker.
Oh, man, I just thought of that.
That's going to pick up speed next season.
That's it.
It has to.
Who
would have thought that
my
she
joke
would,
or utilities in general?
No, Captain America.
Captain America.
The power broker.
Oh, the power broker. Yes, from the episode.
Okay, so now we're caught up. Josh has now watched the entire first season of
Good.
Winter Soldier.
And Falcon.
And Falcon.
Yeah.
Now it's Captain America and the Winter Soldier.
Is that what they're calling it?
Yeah. They announced it at the end of the first season.
Okay.
So anyway, that's not what we're talking about today. We're talking about bonds. But first, we have had some pretty special guests lately.
Yes.
So, Josh, run through those just in case someone wants to listen to them before they get to this super exciting bond episode.
So if this is boring you and you want to jump out real quick and be woken up, there was a great episode we did in our series Ask an Advisor, and we did part 2 of the college edition where we had Mackenzie Murphy on, who is our marketing intern, and she was able to do some questions from her and her friends about things that they were interested in, which was a really good episode. And then we just recently had co-founder of Hickson Zucker Capital Management, Tony Hickson, on to discuss his latest book, which is called Retirement Stepping Stones, which is a great read, a really good episode. Make sure you check that out.
Yeah, check that. If you haven't listened to that, go back, listen to it, and come back to bonds. You can always come and listen to bonds.
They'll be here.
It'll be here.
Yes.
So, yes, bonds.
Bonds.
That's what we're talking about. They're very different than stocks. We spend a lot of time talking about stocks. The financial news, the media spends a lot of time talking about the stock market, when in reality, the bond market's actually larger than the stock market around the world.
About 3 times.
And it's very important to have an understanding of what that is, even though it's not as exciting or fun on a high level. So let's just break down 50,000 foot like we typically do.
Yep, startup.
Very different than stocks. With a stock, you own Josh Robb Corp. There's 10 shares outstanding, $10 a share, $100 market cap. It's great.
Yep.
If you own one share, you own 10% of the company. You own a share of Josh Robb Corp. So with a stock, you own a very small portion, usually teeny, minuscule portion of a company, of a publicly traded company. So you buy a stock for a given price, and you hope the company's going to continue to grow and innovate, and that their share price is going to reflect that growth, and that your wealth will grow over time.
Right. That's
how stock ownership works, and that's how we spend a lot of our time talking about. The key word there is own. You own a small piece of a company. Okay, you're a business owner. So let's say that the business will sometimes be worth more. It will sometimes be worth less in the eyes of the market. You are bearing the risk in hopes that it's going to be worth more over time. Time's the key there.
Yep.
Bonds different.
Yes.
Bonds are way different. With a bond, you don't actually have ownership of a company. Or I guess we're also going to talk about governmental entities a bit today, but you don't actually own that.
Right.
A piece of it. Instead, you, Josh Robb Corp, no, just Josh Robb the person, you're lending your money. So you're going to say, U.S. government, I'm going to lend you my money, and then I'm going to be promised that you're going to give me interest in the middle, sometimes at the end, but that's another topic for another day, and my money back at the end.
Yeah, so I'm going to charge you for holding my money and using it, and then you're going to give me my money back at some point in the future.
So think of it like with stocks, you're an owner. With bonds, you're a loaner.
No,
not like you're by yourself. No. And that's a Nick Murrayism, and we've referred to him before.
Yes.
But yeah, you're an owner with a stock, you're a loaner, you're loaning your money with bonds. Yeah. So let's just briefly...
And I always say, a great way to think of a bond, a lot of people who own their home have a mortgage. That concept, when you think about it, is what a bond is. So a lot of people can kind of associate with that is the bank said, hey, you want to buy a house? Here, we'll give you some money. You owe us interest, and you're going to pay us all back everything we had plus that interest.
Yep.
That's just the reverse of a bond.
Exactly.
We're giving out our money to a entity, whether it's a company or the government, so that they can use it for whatever they want.
Yep.
And in turn, they're going to promise to pay us back in interest and our initial thing we loaned out.
Absolutely.
Perfect.
So let's give like one sentence definitions for some key terms.
All right.
Number one, duration. Josh, explain duration in one sentence.
Yeah. Duration is really the length of time that you're going to have your money being lended out.
Yeah, absolutely.
So if the duration is 5 years, for 5 years,
your money's locked up.
They're going to have my money, and they're not obligated to pay it back until the end of that duration.
Coupon is another word, and that is just the periodic interest payment.
Yep.
And that's in dollar terms. The coupon will be in dollar terms. Now, when you flip the table, you can look at yield. Yield would be the percentage, usually of par, or what the bond was issued at, that you are getting as a percent of your interest payment. So, two different terms there. Yield to maturity, Josh?
Yep. So that's the yield you're going to get if you wait all the way until it comes back to you. So that duration. So the yield to maturity takes that coupon payment. So let's say it's a 5-year bond and they pay it twice a year. All right. And so you're going to get 10 payments over that 5-year period. And they're going to say, okay, if you're paying $100 per payment, this is how much you're going to earn. That's the yield for that time frame.
Right. So before we get to yield to worst,
yes,
because that's another key one, we have to talk about what a callable bond is, because that's typically the big difference there.
Yes.
So callable bond, so call meaning the right to buy, it's like an option.
Yes.
And this is an option on a bond that the issuer has in place when they issue the bond. So say Walmart issues $100 million of 4% coupon bonds, 10-year bonds, whatever. If they have if it's a callable bond, they have the right to buy it back between whatever time period they specify or from a period on. So, therefore, the yield to worst is a common term there. That could mean the earliest time that bond could be either called, or if there is no call option, it's going to be maturity at that point. So that will be really if they call it early, you're going to get less yield because there's less coupons after they would have called it. So it's going to be a different yield calculation that way.
Yeah. And when you're looking to invest, if there is a callable bond, you have to take the worst case scenario into factor. So that yield to worst is to say, okay, if I were to buy it now and it's a 5-year bond, but in 3 years they have the ability to call it back, I need to know that's my worst case return I could get out of it. Am I comfortable with that? It may go all 5, but I don't want to be upset if that's my end point and I didn't figure that in. So
and
that's that yield to worst.
It's probably also worth pointing out that typically if you're buying a callable bond, you are compensated with a bit of additional yield to make up for the risk that they could call it back in advance. That's just the bond market is very transparent on how it works.
Yes.
It's just math.
Yeah.
So it pretty much, if there's a put one way, there's a take somewhere else, and it all works out in the end.
So if you have 2 5-year bonds, one is non-callable and one is callable, your yield to maturity is going to be higher for that callable because you're taking a risk that you may not get there.
Yeah.
And so, that's
so
very
credit
clear.
rating, something we should probably talk about. So first of all, to confuse you further, Standard & Poor's and Fitch are 2 major rating providers. They use the same system. That's great. Moody's is another, and they use their own.
Yes.
So that's just going to confuse people further. But I'm going to go through them in order from very highest credit rating to very lowest credit rating.
Yeah. So not only do you have multiple people rating them, which is good because then you don't have just one company that gets confused, but they don't use the same rating scale.
No, they do not.
Because, why?
Why would you do that?
Yeah,
that would be too easy. So I'm going to go to the top.
Yes.
Number one, so best credit rating you can have according to S&P and Fitch, AAA.
AAA.
Then you go AA plus, AA minus.
This is the batteries. Yep.
A plus, A minus, triple B plus, triple B minus, double B plus, double B minus, B plus, B minus, triple C plus, triple C minus, triple C, D.
All right. So you just threw a lot of alphabet at me.
Yep.
Pretty much, it's if you think of grading, if I go to school,
very
I get a grade,
similar.
It's, besides AAA is all by itself, right? There's only AAA. There's not a plus or a minus there. But after you get past AAA, it's the plus, then the regular, then the minus.
Yep.
That's it. So A plus, regular A, A minus. Just think of grades. That's how it works.
And
Pretty
you're taking
easy.
away letters if you're repeating them.
The fewer the letters, and yeah.
So
wait, and I'm sure we're going to talk about this in a little while, But at some point, we get to the term junk bond. And as you're working through that scale, just throw it real quick. Where does that land?
Below triple B.
Yeah. So like that. Triple B is kind of your threshold.
Right. Because triple B is kind of like the investment grade
yes, and
threshold.
Then you go up. Yep. And then down from there is what you may hear the term junk bond.
Yep. Or
it
high
doesn't
yield.
mean it's junk or high yield. They're interchangeable. It just means the rating is lower. You get compensated higher because you're taking a risk.
You get more yield, but there's more risk because of a default risk, which is something we're going to talk about.
So that's that. The triple B is that threshold.
So Moody's changes it up a little bit. And theirs
cool.
makes a lot less sense.
Yep.
So they have a mix of uppercase and lowercase letters for one. But I'm gonna call them AAA. You have AA1, AA2, AA3, A1, A2, A3, BAA1, BAA2, BAA3, BA1, BA2, BA3, B1, B2, B3, CAA1, CAA2, CAA3, CA, and C.
That's dumb.
So if I was to choose, I would just go with the S&P Fitch system of credit ratings. But
it's a lot easier, in my mind,
I think the people
because you grew up with a grade
scale.
scale that has a similar thing.
I think that the people were awfully moody when they wrote the Moody's list.
I mean, it sounds like farm animal noises for some of those. Bah 1, bah 2. I don't know. That's crazy.
So another one we're going to mention and come back to is convexity.
Convexity.
That's Josh's favorite
Google
thing
that
in the world.
Convexity formula.
Not if you're driving.
And see what cool formulas come up with that.
Yeah. So
good times.
Something to talk about is that debt rating determines yield.
Yes.
So the more risky the debt issuer, the more likely an issuer is to default. So default meaning go out of business, be unable to pay what they owe, and that would be what they owing you, the investor, money, or other investors. So that is kind of going to be compensated through a higher coupon, a higher yield on their debt to compensate for that additional risk. Mm-hmm. So, and that happens as you move further away from risk-free. So risk-free, think of like a U.S. Treasury bond. Like it is essentially risk-free. As long as the government is around, they're going to pay their debt.
Yep, sure. Mm-hmm.
That's what they say.
Debt ceiling.
That's what they say. And then there's zero risk that you won't get paid is the way it's discussed.
Yes.
So in theory, that's the way. However, in practicality, to be determined down the road.
When it comes to investments, that's risk-free as you get in the bond world.
So as you work away from risk-free, so away from AAA, then your interest payments were going to increase. Your interest yield is going to increase, but so does default rate at the same time.
Yeah, and again, it comes back to the same is true with stocks. Again, when we're talking about investing, a lot of the underlying concepts are the same, right? The more risk I'm going to take, the more I want compensation for that risk.
Right.
So you see that with stocks is that you get a higher price point or a different PE ratio. If I'm going to take risk, I want to
higher
be
return.
compensated with a higher potential return. Here on this side, bonds, if I'm going to take a higher risk of the company defaulting, meaning not paying me back, I would like you to offer me a higher interest rate to borrow my money.
Yep.
Same concept.
So now we're going to talk about the inverse relationship between bond prices and bond yields.
Okay.
Now, we've talked about this before on the show, so we're not going to go too much into detail. But in general, think of it like this. So, like, have you heard that stocks and bonds are often thought to be negatively correlated?
Yes.
That's kind of a common thinking. So, here's how this works. As people are bullish on the economy, they buy stocks.
Yes.
What do they do to buy those stocks? Generally, they're going to sell bonds.
Yes.
So they want to participate in the profits, the economic growth that's going on, and the selling of those bonds causes bond prices to fall and bond yields rise because the coupons are fixed. So that's kind of how it's similar to how a dividend yield would work. So if the company holds their dividend flat, but the stock price dips, their dividend yield goes up. Right?
Because what you pay to get that is less, but you get the same thing for it.
Yeah, or the other way around. You know, as a stock goes up, if the dividend stays the same, the yield will go down.
Right.
So that's kind of how that works. It works the other way for bonds too. When investors get fearful, they then turn around and sell their stocks. So that obviously is putting pressure and causing the stock market to drop. They go then and buy bonds. So then the buying of the bonds sends the bond prices up, which causes bond yields to fall. So similar to what we just talked about.
Right.
So that is about the inverse relationship between bond prices and bond yields and really how they correlate with stocks.
Yeah, and we should be very clear when we talk about an inverse relationship that usually means they move in opposite directions.
Yep.
But real life, there are times where they both move the same direction. Like 2008, 2009, there was a lot that was going on, and both fixed income and stocks were down for a while. It doesn't mean just because stocks are down, bonds are up. They're normally very little correlation between the two.
True.
Normally, in a normal market, they are oppositely or negatively correlated, but it's not a guarantee.
And how often are we in a quote-unquote normal market?
Right. So just keep that in mind when we're talking about this is normally, and when you just, again, go back to just straight math and how that works, that's usually the case. But again, when you apply economics and things going on, sometimes they move the same direction. And, last year when interest rates were being adjusted by the Fed, that put a pressure on the fixed income world. At the same time, there was pressure on the stock market.
Absolutely.
Two different things causing pressure, but from a price movement standpoint and returns, they were moving in a similar direction.
Yeah. So let's break down just at a high level some different types of bonds. Because when you say bond, it's very different. So just like there are tons of different kinds of stocks out there, we understand that. There are different types of bonds, and this is a very short list. There's even a much bigger list. This is just a short list. So first of all, U.S. Treasuries.
Yes.
Or government bonds, generally from an issuing government around the world. Similar sort of thing. German bunds, whatever, these kind of things. They are the official, quote-unquote, they're often thought of as risk-free debt. Because of that low risk, you're obviously going to be compensated very low in terms of yield, but you have very little risk when that happens.
And depending on the type of government bonds, and I know we'll talk about some in a minute, but there was war bonds back in the day. There's different types, and they offer some incentives too. If the government's trying to motivate those purchases, they, being the government, can say, hey, this bond is tax-free.
Yes.
And so you'll see those periodically, different types of bonds. There's some educational bonds out there, some EE bonds and things like that. All have different structures based on what they're trying to accomplish for people investing in them.
So speaking of tax-free bonds, municipal bonds. So think of a municipal bond like issued from a municipality. And that could be either a state or local government. They can issue school. They can issue bonds to then use that funding to build roads, update a town, build a new building, anything like this. And the unique thing about those is that they're not risk-free for one.
Right.
They have different credit ratings. You can buy them insured or non-insured, and there's a lot of variables when it comes to munis. And there are different areas of the country that are better for munis than others. Some places have run their finances a little bit more conservatively than others in the past. And you can buy ones that are funded based on tax dollars or whatever. So there's all kinds of different munis out there. But the key differentiator is that the income that you're getting from them, the coupons, that is federally tax-free.
Yes, and some are state and local tax-free depending on how they're issued.
Yep, so that's a unique thing. So if you are living in if you have a high tax situation in your life, this could be a way to get some federally tax-free income, potentially more. So that's a unique experience there. Corporate bonds, these are just bonds issued by corporations, very, very common all around the world. Asset-backed securities, mortgage-backed securities, really when there are loans, mortgages, for example, a lot of times, you're going to think of 08 and 09 when I'm talking about this, but that's kind of what caused a lot of this thinking. But banks could bundle together millions of dollars worth of mortgage debt and sell it to an investor. So an institution likely would be the investor that would buy that. And they would, previously, before the global financial crisis, make killer returns on this kind of stuff. It was
collecting the payments being paid into those mortgages were then packaged into as interest payments out to the owners. Yep.
And back then, interest rates were good. Risk was low. Then the global financial crisis hit, and it was not a good place to be for a while.
Don't own those.
However, now it's a pretty good place to be. The banking system has stabilized. We have a lot of rules and regulations in place to protect people. So mortgage-backed securities, asset-backed securities, they're coming back. They're very popular, and they are a good way to get an additional yield on top of what you can get through a treasury or even a corporate bond.
Yep.
Another option, and we're going to talk about it a little bit more later, TIPS is what they're called, Treasury Inflation Protected Securities. So it's a treasury, but it's a treasury with an adjustment for inflation.
Yes.
And we'll talk about how inflation and fixed income work together and how that is actually kind of risky
can't wait.
later. That's Josh's favorite topic in the whole world. Another one's floating rate loans. So like think smaller loans
For boats,
that
yep.
they do not have a fixed interest payment, right?
Yeah.
So as interest rates go up and go down, the coupon goes up and goes down for the debt holder on that. And then I did want to point out, and we're not going to get into it too much, but all of these are available inside and outside the United States through emerging markets, through international developed markets, Europe, Asia, Africa, South America, everywhere.
Yeah, I mean, the concept of lending has been around for centuries. I mean, it's not
thousands
of years.
Yeah.
It's not a new concept for governments to do this, for companies to do this. I mean, the concept of, hey, can I borrow some money because I think I can use it to grow, to utilize for some opportunity I have, and I will compensate you for letting me do that.
So essentially, if a company can go out and borrow money very cheaply, even if they don't need it right now, they're often going out and borrowing it because it's like you can borrow it at 1-2%. It's just dirt cheap. So they're just going to take out all of the, to get there. What's interesting about debt is that from a personal finance standpoint, it's very disliked. It's not necessarily a good thing. We tend to try and avoid it if we can. We encourage clients to do the same. Well, from a business standpoint, if you can borrow money and then invest it into projects, into acquisitions, and earn more than you're spending on it, it's actually really encouraged to a point. Everything's to a point, but it's a very different world than it is in the private world.
And there's a calculation to figure that out. And again, a lot of this comes back to just straight math.
Yeah.
Is if my fixed borrowing costs, which is the interest I would owe, is less than my potential return on that cash I will receive, then it's a good project and it's worth the debt.
Yes.
And it's, you're right. And that's what businesses do is they say, hey, you know what? I'm okay having millions of dollars of debt on my books because the millions of dollars I'm putting to use and earning more than millions of dollars on that investment. And so it all equals out to be good. You're right. Let's take a quick pause, wake everybody back up, and do a dad joke of the week.
Dad joke of the week.
Yes.
Bring it.
Did you know you can throw an envelope as far as you want?
Time out. Is it envelope or envelope?
Envelope.
Why?
Because that's how I pronounce it.
Okay. I'm just curious. I really want to know.
Yeah. Well, if it's a big one, it's an envelope. If it's a small one, it's an envelope.
That's so goofy.
That's how it works. Just look it up.
I've said envelope.
Where's your emphasis?
I've said envelope. Where's your emphasis? Emphasis. I've said envelope my entire life, but I know, but half the world says envelope. So I've just been curious.
So if you throw one of those, as far as you want, it will still be stationary.
Stationary. That's good. I like it. So Josh, the question that you're thinking at this moment,
I'm thinking it.
You're thinking, so can you even lose money on a bond?
Yeah, because if they're just paying you interest and you get your
How
money
can
back,
you lose money?
how do you lose money?
This is a great idea.
It's a great question.
Okay, so considering
we've cracked the code to
this is it. This investing
eternal wealth.
So considering you're loaning money and getting a fixed income stream, you may think, no, can't lose a dime, right? You'd be wrong.
I would be.
You'd be wrong. So purchase price actually has a lot to do with the total return of a bond. So if you're buying a bond in the market, you're unlikely to pay exactly the issuing par amount, especially if you're buying on a secondary market.
Yes.
So par is the issuance price. Generally speaking, they look at it in terms of 1,000 or 100 or 10,000 just to try and even it out when they're issued. So if interest rates had moved up since the bond was issued, your bond is actually worth less because its interest rate is lower than the market is now. So you may be able to buy it at a discount, or if you already held it, it's lost value since you purchased it. So the opposite's also true. If interest rates have moved downward since the issuance, your bond is actually worth more because its interest payment is higher than the market is now. And you may, if you're buying it, have to pay a premium for that bond, or your bond has appreciated since you purchased it.
Yes.
Now,
so pause there.
So
we mentioned that you get your money back at the end.
Yeah.
You get par.
You get par back. You don't get your money back.
We were intentional in that because that's, the assumption there was you bought a new bond, newly issued bond at par. But the idea is, so if there's a bond out there, and let's say it's trading for 110, they go in those increments.
Yep.
All right. So I pay $110 for one bond, which is not how it works, but let's just pretend it is. And then when it matures, I get $100 back.
Right.
Now you're like, oh, you just lost $10. Why would you do that? Well, it's at a premium because that interest rate
is higher.
And so my collection means that when I'm all said and done, I probably still made if I'm doing my job right and looked at yield to maturity, my yield was positive, meaning I made money on that bond. But maybe I get $100 back and I made $30 during that time. So,
Yeah.
my total, I made $20 when you subtract off what I didn't get back from the initial.
Yes, it's not a perfect relationship.
Nope.
It's very tricky, and interest rate movements can be very large.
Yes.
When interest rate movements are very, very large one way or the other that you can either stand to make a lot of money in the bond market or a lot of times lose a lot of money in the bond market. Most of the time interest rate movements aren't so large, and the price, as we'll get into in a little bit, the price impact from interest rate moves is not as drastic as stock market moves. Right. So the volatility in the bond market is a lot lower. It is rare that you would lose a lot of money in the bond market. It is not uncommon for you to lose a little bit of money in the bond market.
When you lose a lot of money is defaults and bankruptcy.
Exactly.
Yep.
So I hinted at it. This is Josh's favorite part of the episode.
Complexity.
Convexity. So like I had just mentioned, it's not necessarily a one-for-one relationship. If yields go up 1%, the price does not go then down 1%. Like it's not one for one like that. But convexity is a term that kind of explains this, and I'm going to just tip my toe into this because it's very complicated. But convexity is a relationship between price and a change in yield. So the higher the yield or the longer the duration, the more sensitive to interest rate movements a bond's going to be. So for example, a 30-year treasury will move more in price on a percentage basis than a 10-year treasury for the same interest rate move. Yeah. Also, a high-yield, low-credit-rated corporate bond is going to be a lot more sensitive to interest rate movements than a U.S. Treasury because the higher yield on that high-yield bond is due to the higher risk that you have on that. So interest rate movements affect different bonds differently, like I had just mentioned. That 1% yield change is not going to be a 1% price change. There are many, many factors that go into this, but that's just like that's not even 50,000. That's like 100,000 foot view of convexity. Complexity, as Josh calls it.
Complexity for the convexity. So high level, if you were to Google the formula, because I was going to actually like read the formula out loud.
Oh,
to you.
Man.
And there's just so many like pieces that I don't think I could do it because it's like 1 over the bond price times 1 plus the yield to maturity in decimal form squared.
Well, naturally.
And then that then you take that to then you take the cash flow by time over that same formula, 1 plus the yield to maturity, not squared this time though, to the number of years times the maturity in years squared plus the T or the time frame they're using.
Or to throw another wrench in it, if it's a callable bond, you're going to use the yield to worst.
Yep, yield to
instead
worst.
of yield to maturity. So there's a lot of options here.
Yeah. But it's complexity for convexity.
Complexity is convexity.
But the high level, like you mentioned, is just a way of putting a number to give you the ability to compare when you're looking at different investment pieces to say, how does this factor
Absolutely.
in? And which one of these is a better investment for what I'm trying to achieve?
Yeah, it's really like which one is at most risk for interest rate movements.
Yes.
That's really the way to look at it.
Yep.
So if you have, higher convexity means it's going to be more impacted than interest rate moves.
I better see a higher yield
exactly
to make that one a better choice than that somebody else look at.
So numbers are my jam. We know this. We talk about them weekly.
Oh, yeah.
Let's talk about performance for bonds in general, and then we're going to compare bonds to stocks. Okay. So this is from a great NYU professor's analysis, well respected. I'm not even going to name him because he's just that smart. You know who he is.
I do not know who he is.
I can't really pronounce his last name. That's why
you
don't want to say it.
That's all right. I can't either, so you're all right.
Oswath Damodaran.
That's close enough.
It's got to be close enough.
I'm sure that's exactly right.
He's so smart. He's like the valuation guru of the world.
I think you're on a first-name basis with
we
him
are.
anyway.
Well, I prefer his first name.
Yes.
Yeah. Okay, so anyway, looking back all the way to 1928. So big data set we're talking about here. All the way through the end of last year, so end of 2020.
Okay.
So a 3-month T-bill, so really short-term bond, has returned annually 3.36% annually.
Boom.
Okay, so really short-term bond, 3.36% annually. 10-year treasuries have returned 5.21% annually. Now, because you're locking up your money longer, you get compensated in terms of more return.
3 months to 10 years. Yep.
So looking at a BAA rated corporate bond.
So the lower end.
Yep.
But not the low.
But not the low.
But lower.
It has returned 7.25%. So again, annually. Now that's more risk and more return.
Yep.
Now, continuing the theme of more risk for more return, the S&P 500 total return, so that includes dividends,
Yep.
over that same time period, 1928 to 2020, has returned 11.64% annually.
Wow.
It's a big difference.
Yeah, so you go 3, just over 3 1/3, 5%,
Yep.
7%, and then over 11.5%.
Exactly.
And again, the volatility, you're getting paid for the
risk.
taking the risk on for more potential for returns.
And it doesn't even sound that big of a difference until you put dollar terms by it. So let me check this.
You got a sheet of paper
I got a
for
sheet
me.
of paper.
Sheet of paper.
Okay, so Josh,
Yes.
say you put a hypothetical $100 into a 3-month T-bill in 1928.
Yes, when I was
so like
negative
the
400
yeah
years
the
old.
year
Yep.
you were the year before you were born.
Yes.
So you put $100 into a 3-month T-bill in 1928. What is it
And
worth?
I said, let it ride.
Let it ride
For more than 3 months.
and like keep reinvesting.
Yes.
Yeah. So what is that going to be worth today?
3.36% annually. You already told me. In dollar terms, though.
In dollar terms, that $100 has turned into $2,081.
Boom. Retirement money.
Retirement money. Okay, so suppose you take that same $100 and you put it into 10-year treasuries.
Okay. 10 years.
Since
Rolling.
1928. Rolling, yeah. That same $100 has turned into $8,920.
Boom.
Okay?
4x that.
So now we're going to take that same $100 and we're going to invest it in 1928 into corporate bond
Yes.
that we had just mentioned. That $100 is worth $53,736.
Ooh.
We're getting somewhere,
There
right?
you go.
53,000. That's your number to remember in your head.
53,000's in my head.
Or Josh in 1928, which wasn't great timing, by the way.
No, things were happening.
Yeah, things were getting pretty good before they got really bad.
Yes.
So in 1928, you put your $100 into the into an S&P 500 index fund and reinvested your dividends.
Okay.
Okay.
And let it ride.
And let it ride. You never touched it. Your $100 investment in 1928 is now worth $592,868.
Oh, wow.
That's a big difference.
Between 53, the most of our scenarios,
The most aggressive bond,
that
7%.
we looked at, you're getting 53,000 as opposed to 500,000.
593.
Almost 600,000. Yeah. Crazy.
So that's how it gets crazy. So let's look at a little bit closer time periods here, 1971 to 2020. So you're looking at 50 years there. 3-month T-bill, 4.51% annually. 10-year Treasury, 7.29% annually. Corporate bond, 9.55% annually. S&P 500 total return, 12.18% annually.
A little bit higher.
Little higher.
During that time frame.
Now let's bring it really close to home. So we're looking at the last decade.
Okay.
So 2011 to 2020, 10 years. 3-month T-bill, 0.51% annually.
Oh, man.
10-year Treasury, 4.64% annually. Corporate bond, 7.44% annually. S&P 500, 14.34% annually.
Oh, wow.
Big differences.
And we talk about this a lot. We didn't really touch on it because bonds, again, there's a lot of complexity to it all. Not convexity, complexity to the bonds is what's called a yield curve. And what you saw here was in the short term, having a 0.5% annually for the 3-month and still 7.4% for the corporate bond, or even just the 4.6 for the 10-year. That curve is pretty wide.
Pretty steep.
Pretty steep. And for when you look at the longer term, they're a little more narrow. It's not quite as steep because you got 3, then 5, then 7. So, yeah, that's telling you what's happened recently in interest rates, and especially on the short end, that you're really losing a lot of that yield and return potential.
Right. And since the 80s, really, yields in the United States have, and around the world, but I'm specifically talking about the United States, have been not down all the time, but the downward trend has been persistent for 40 years. So, as we can see, bond performance has been much less favorable than stocks over time. So, Josh, the question in my mind is why someone would want to own the dang things.
Yes.
Why would you want to own bonds?
Yeah, because if you look at return, and we didn't mention this, those were total return numbers. Real return is after inflation.
Correct. And I have inflation figures if you
You
want
have those in there.
So, for on average, from 1928 to 2020, you averaged 3.02% inflation annually. From 71 to 20, 3.91, and from 2011 to 2020, 1.78.
Okay. So let's just look at the longest one there.
Yeah, so
3%. Let's round it to 3% for inflation. Treasury bills, you had a real return of about 0.36. Yes, 0.36% annually. Treasury, you had a 2% return. Corporate bonds, you had a 5% return. And stocks, you had a 9% return. So there you can see your real return, your growth of your money after accounting for inflation, the difference there. If you look at that shorter, the last 10 years, you're losing money because you had a 0.5% for the T-bill and you had a 1% inflation, right? Was that the number?
2.
Okay, 2% inflation. So yeah, you lost 1.5% there.
You only made 2% on 10-year treasuries.
Yep. And corporate bonds, you're at 5%. And the S&P, you still had a 12% return. So why, you ask me, why is it's not for the long-term growth? It's, like we mentioned before, volatility dampener.
Right.
It reduces your short-term volatility. And so, yeah, why would you want to hold it? The reason is I'm uncomfortable or unable to maintain my equity exposure experiencing the full volatility of the market.
Yeah, because on paper, 100% equities.
Yes.
That's just the mathematical answer.
If you just do math.
If we lived in a perfect world where emotions, where plans, where lives were not in our, in your brain. Exactly. Then 100% equities for everyone all the time.
Yep.
Why do you need a bond? But we don't live in that world.
No, we don't.
We don't live in that world. So yeah, bonds serve as a way to bring down the volatility of the portfolio. So when you combine stocks high volatility with bonds low volatility, or often negatively correlated volatility, you often get a level that most people can be comfortable with. So you're never going to have zero volatility unless you're in cash. Cash is trash.
Yes. Right now.
Right. But you can rein in the swings to levels that people can sleep at night with.
From a financial advisor world, there's an efficient frontier, meaning that there's a asset allocation, there's an investment group that you put together that gives you an optimal return for your goals and for your tolerance. So in other words, increasing your exposure, decreasing does not provide you any return on top of what you're getting for the volatility you're achieving.
Right.
So there's this efficiency where you say, you know what, maybe for this person, based on their goals, what they're trying to do, and the risk tolerance, 60-40, 70-30, 80-20, who knows where it is, but there's some efficiency where you say this is the optimal way of getting the most return with matching the volatility needed and required for it.
Yeah, exactly. So a perfect financial plan that allows people to rest easy and still meet their investment goals that include growth. So for the most growth, obviously, the more stocks, then therefore volatility you can handle, the better off you're going to be. But bonds are added to bring that volatility level to where it's needed for comfort.
Yep.
So
and then again, the other factor is what type of income do I need? If I need tax-free income, then there are municipal bonds, like you said. There are other reasons maybe why you need certain bonds in certain situations for what you're trying to achieve tax-wise as well.
Right. But proof's in the pudding.
Yes.
Proof is in the... I could go for a cup of little snack pack, a little chocolate snack pack.
That's good.
That'd be pretty good. I like tapioca myself.
Gross.
So let's think about 2008. Terrible year for the markets, right? Global financial crisis, housing bubble, bad, not fun. Large cap U.S. stocks, they were down 37% for the year. Now that's for the year. They were down more at the bottom, but for the full calendar year, down 37%. Emerging market stocks down 53%, small caps down 34%, and international developed down 43%. It's pretty bloody in the equity markets, right?
It was rough.
So all this stock market carnage made bonds attractive, right? Bonds were actually up 5% for the year. Now, there were puts and takes in the middle, but for the year, up 5%. So, suppose you have a well-diversified portfolio with U.S., large and small caps, international developed, EM stocks, even 25% in bonds. While large cap stocks were down 37%, you were only down 25%. And that's with only 25% in your buying bonds there. And the more bonds you had at that point, the better relative to equities you did in that environment. Now, we need to keep in mind that things turn around quickly. So in 2009, having that same allocation would have generated a 25% return. Because of the way it works, you still wouldn't have quite been back to break even, but a lot closer than an all-equity portfolio prior to that. But large cap U.S. stocks, they were up 27. Emerging market stocks up 79. International and developed stocks up 33, and small caps up 27. So the way I like to think of it, fixed income's a parachute when the stock market's falling, but it's an anchor when the stock market's rallying.
No, good word pictures there.
Can you just? I just made that up today, Josh.
Perfect.
That's perfect. So we hit on it a little bit earlier when we were talking about tips. Let's talk about inflation.
Have some tips for me?
I have some tips for you on inflation. So inflation is a real risk when it comes to fixed income because of the nature of fixed income being fixed.
Yep.
Unless you're talking about tips. So bonds, collectively known as the fixed income asset class, you're getting a steady income stream from loaning your money. Where this becomes inconvenient is when retirees have a lot of fixed income. And then inflation occurs in the economy. So your income stream isn't changing, but the cost of things are going up. So you have less and less purchasing power, less and less money left over, less and less freedom. Tips can help with this. You get additional income adjusted to inflation in addition to the coupon. That's one way.
Yes.
But stocks are really the only long-term solution for growing income, especially if you look at like a dividend growth focus. You need income? Buy a stock that grows its dividend. Oftentimes, you can find mature but still growing companies that increase their dividends 10% per year. That's a rule that we like.
It is.
It's called the 10-10 rule.
Rule of 72.
That is a great rule, too.
It's a formula or a calculation just tell you how often your interest, your return, whatever percent you're trying to calculate will double.
Yeah.
So you take that percentage and divide it into 72. And you get your number. So
if you have a 10%,
divided by 72, 7.2
7 years,
7.2 years,
your income doubles.
Is going to double. So that's a good way of looking at it. It's a great solution. You know, one thing that we talk about, and this whole thing factors into it, is bonds reducing volatility. All right, and for some people, that's just they need to have in their allocation. For retirees or people getting close to retirement, that is huge because when you make a big transition and you start drawing from your portfolio, what happens in the market in those early years of retirement is huge. There's a thing that's called sequence of return risk, and what that means, high level, is that the order of your returns, because we know the market doesn't give you a flat return every year. You don't get 6% per year.
That would be called
it's
fixed
up and
income.
down. That would be fixed. But in real life, even with a diversified portfolio, you get ups and downs. And those first handful of years are crucial for the long-term success of a retiree. If you have bad years early on, it is harder to recover from than if you had those same bad years in the middle or near the end of your retirement. Reason for that is, if you are retiring and the market is down and you have to start drawing from the portfolio, you're taking money out at a lower starting point and you make it harder for that to recover back up since you're taking withdrawals out of that portfolio. So sequence of turns matters. So sometimes having some fixed income exposure heading into retirement helps alleviate the pressure on your growing piece of your portfolio, the equities, and allows you to then let those recover if there is a downturn early on. So putting a bear market fund, we call it a bear market fund in the sense that if the stock market is down, don't touch it. Draw out of this piece that is negatively correlated usually, or at least very less impacted by those type of movements, and live off of that and let that equity exposure recover before you start drawing from it.
Yes.
So that's what it is.
So sequence of returns. Yep, very important at that late working, early retirement phase of life.
Yes.
So you might ask me, Austin, how could I invest in bonds?
How could you do that?
So first of all, you can go buy individual bonds.
Yes.
You can buy individual treasuries, munis, corporate bonds, whatever you want to buy. You can do that, and that is it's kind of a job because bonds mature at different times, and depending on how you want the coupons payments to come in and the maturities to line up, you can make a whole fancy spreadsheet out of it if you want.
You could.
As well as the tax situation is very different. There's a lot to keep track of there. So some people do it that way. A lot of people choose to do it nowadays through ETFs, and we've talked about those before. We have an episode comparing ETFs to mutual funds if you have any questions. We'll link that in the show notes. But one common one is the iShares Barclays U.S. Aggregate Bond ETF, ticker AGG.
Yep, because
the most common one is the aggregate
bond index.
So it's got a little bit of every kind. There's treasuries, there's munis, there's corporates, there's everything. There's all kinds of stuff in it, different weightings. But that is a way that a lot of people get exposure to that. Another one, PIMCO, is a mutual fund company that They're the fixed income experts,
At
least around here.
They're
they know their stuff.
Their expertise there.
They have a PIMCO active bond ETF, ticker BOND. They must have got that one early.
They grabbed that.
Yeah. So they got that one. They roll with it. They actively manage it. It's an actively managed bond portfolio. Another one is an iShares National Muni Bond ETF, ticker MUB, if you would like the tax-free income portion of that. Alternatively, mutual funds are a way you could get into this theme. The Vanguard Intermediate Short-Term Investment Grade Fund, VFICX. Vanguard, typically very cheap. Good way to get exposure there. Double Line Total Return. Double Line, another great bond company.
Yep.
Bond management company. DLTNX is the ticker there. Invesco used to be Oppenheimer Senior Floating Rate Fund. If you're looking at floating rate exposures, if you want to ride interest rates rising or whatever.
Or ride it when they fall.
Then you're going to go down. Yeah, that's when you don't do good.
Yep.
OOSYX is that one. So not saying any of those are recommendations.
Like
always, every situation, talk to your advisor. If you don't have one, hey, give us a call. We are happy to talk to you about your financial situation. You can also check out the Invest With Us tab on our website. So, Josh, the question then is, should you invest in bonds?
Well,
I think we kind of just answered it.
It
but
depends.
I don't think we can say it too much.
Yes. It really depends on what your long-term goals are and what your volatility acceptance is. How much can I experience without reacting negatively to my portfolio?
Yep.
Determines what your asset allocation should be. And also, again, depending on where you're at in your career, there may be some times to have some extra fixed income exposure to eliminate that sequence of return risk as you head into retirement. So as always, what should you do?
Talk to your advisor.
Talk to your advisor.
So some general rule of thumbs for asset allocation as it relates to stocks and bonds. Generally speaking, if you can stomach it, based on your personal volatility tolerance, 100% equities earlier in your career is going to give you the best chance of good growing money over time. Then, as you get closer to that retirement point, as Josh had kind of mentioned, not putting any numbers on it, but you can generally start adding in a little fixed income exposure to take the sequence of return risk down.
Yep.
And then, actually, a lot of people don't think about this, but as you're in retirement, you get comfortably into it for a while, you can actually start adding more stock exposure because you've taken some of the sequence of return risk from the front end out.
Yes.
And you can just focus on growing and giving. So that's a pretty cool thing.
Yeah. I think high level, there is no perfect asset allocation. There's not one out there that says this is the ideal way.
100% Bitcoin.
Maybe that is the perfect allocation. But the ideal is you need to know what your goals are and what's the highest chance to meet those goals. And that's the allocation, as long as you can stomach it, that you should be targeting.
Right. So, Josh, there's this term that I had heard and is industry standard.
Yes.
60-40. 60-40 portfolio is the perfect balance of stocks and bonds forever. You never need to change it. You never need to touch it. Is that true?
So that's what's referred to as like a balanced portfolio. Yep. A lot of retirement planning is based off of that type of asset allocation historically. The problem is, like we just showed in your numbers, interest rates are at all-time lows. And the anticipation is we're going to be low interest rates for a while. We're not going to be seeing those high interest rates we saw in the prior decades. So that 60-40 rule is actually being relooked at, and they're recommending a higher equity exposure to get the same results of a 60-40 portfolio you used to get, because interest rates are not providing their returns into that equation like they used to.
So isn't it like a 70-30 is the 60-40 now?
That's kind of the general consensus, 70-75. And so the reason is you're just offsetting what you're missing out on from those interest payments you were getting.
Now, those low interest rates, another reason that shift is occurring is low interest rates are a boost for stocks.
Yes.
Because they make stocks more attractive, they make the valuations of stocks more attractive, and they make bonds not attractive.
Right.
So that's why that's kind of that shift is occurring. And like we had mentioned before, that shift's been occurring for 40 years. We've been working towards where we're at now. Wow. Bonds. Can you believe we just spent a lot of time on bonds? Do you want to do it again sometime?
I had so much fun.
It's my favorite episode ever. Not the third worst, maybe the third best.
That's right.
All right. Well, 2 reminders. Number 1, it's not too late to enter our second half stock draft competition. You would start with a fresh 100,000, and you'd still be beating Josh. And you can buy bond ETFs and stuff in that.
You can.
You sure can.
Yeah,
I don't know if you want. Yeah, it's your choice if you want to do that for until December 31st. As always, number 2, check out our free gift to you. It's a brief list of 8 principles of timeless investing. overarching investment themes and to keep you on track to meet your long-term goals. It's free on our website. Check it out. Josh, how can people help us grow this podcast?
Yeah, make sure you subscribe. That way you get our most recent episode sent directly to you every Thursday. And leave a review on Apple Podcasts. And if you have any questions about bonds, shoot us an email.
Shoot Josh an email.
Yes, I would love to respond to you at hello@theinvesteddads.com. Or if you have a cool topic you'd love us to cover. We always love doing those. Those are our favorite topics to do, knowing someone is interested in it. And then also, if you know somebody who's in love madly with bonds, share this episode with them. I'm sure they would appreciate it.
Sounds good. Well, until next Thursday, have a great week.
All right, talk to you later. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.